Hello everybody, it's me the Boss Hog, and today we're going to look at my stock portfolio as of the week ending the 1st of April. Pretty interesting week, a couple of dividends, some buys and sells. Let's do it. Alright, honestly really a split week. I was at the mercy of the optimism and then more pessimism around the ceasefire in Ukraine. Obviously that didn't materialize and unfortunately at that. I have a portfolio at the moment that's definitely overexposed to both growth and consumer discretionary. And both of those things are impacted by sort of an expected delay in rising interest rates, as well as inflation, which is expected to be eating holes into people's disposable spend. Now, in fairness, I think I have some good companies that I think are quite resilient even in that sphere, but that's ultimately what's keeping my portfolio down at the moment. So we'll see whether I turn out to be right or indeed wrong. I added £613 this week. That might look like a really weird amount, mainly because it is. This is really though because it was a shortfall in hitting my £5,000 target additional capital contribution between January and March. I'd already topped up my ISAs for this tax year. For anyone who's not aware, those are very tax advantaged accounts. But I really wanted to hit at least 5,000 this year, as in this calendar year. But to be honest with you, after April the 6th, most of my capital was going to be into those tax efficient ISAs, which are then reopened for the new year. So I'm not expecting to add a ton outside of that. So, I have my own targets for hitting ISAs, etc. But for purely, general invest accounts outside of those ISAs, I wanted to hit this target. So that's why I decided to top it up. Honestly, not a ton of trading this week. I would say I did most of my sort of preparation for the new tax year last week. For anyone who's not seen that video yet, I basically trimmed some actually tech stocks out of my non-efficient tax accounts because I'm going to be moving them over once the new year starts. And do dividends. So I no longer have Goldman Sachs. I was sort of messing around a little bit with JP Morgan, Goldman Sachs, and T. Rowe. In the end, I decided that I liked T. Rowe best. I did actually make a reasonable profit on both JPM and GS, so actually I was fine with faffing around. I should have been a bit more decisive though. But anyway, I have a pretty good buy price now on T. Rowe, something like 144. I'm going to be buying more T. Rowe next year, as in next tax year, so April 6th. But only if it's below 150. Like I think it's got good long-term performance historically, but the rise of sort of free brokerages as well as robo traders is a threat. But at the same time, I just think it's a very nice proxy for the wider economic health. So I like it. I think it's a solid company as well. And even if I don't buy more, I plan on holding it for many years. Actually, I'm not sure if it's quite a forever stock at this time, but it will be in my portfolio for many years. So. Anyway, let's have a look at my top 10 next. Okay, so these are my top 10 still. Actually, because I added some, as you'll see, my buys are outside of my top 10. Actually, the top 10 as a percentage of my whole portfolio dropped a little bit to 88.6%. So still a huge part of that. So I'm just going to gloss over the ones that don't have any news this week. So we're going to start with Hollywood Bowl. I would actually say this was my best performing share last week. I mean, objectively, you can kind of see it here from the top 10. There are two reasons for this. The main one was the fact that 10 Entertainment Group, which is a rival but a smaller one, released results that were way better than people were expecting. My thesis is that actually bowling represents really good value for money for like a family activity, and I actually think Hollywood Bowl is like best in class. So if anything, I would say the rise that Hollywood Bowl has wasn't enough. I actually think it should have gone up more. There are lots of buy prices from various analysts here. Berenberg released one last week for 320. I think that's slightly optimistic, but having historically been at 280 myself, I do think a combination of both 10's results, so TEG, 10 Entertainment Group, as well as the fact that like if you look at Hollywood Bowl's shareholder relations, like investor relations, you can actually see that their average spend per game is increasing. So I've kind of extrapolated up from that, and I think like you can reasonably now kind of start approaching the 300s. I'd go somewhere like 290, maybe even 295 as a target, up from my 280. But yeah, it's looking good basically. Hollywood Bowl don't report results until September for their year, so it's going to be a little while till we really know. But I think it's moving in the right direction. I think it deserves to be higher than it is. And to be honest with you, I'm really happy with the size of my stake at the moment, so I'm sort of hoping it's going to go higher. I would just flag Amcor here. I know it doesn't have any news, and that was the weirdest thing about a 10% fall. This is a semiconducting small company, admittedly, but it already trades on a really cheap multiple compared to the wider sector, and I don't really understand this fall. So whereas beforehand I had actually believed I stopped buying this stock, If it goes below 21, maybe even 22, I'm going to continue buying next year. I have 552 shares in it already, so a relatively large holding. No news as far as I can see, and I don't really understand the 10% fall. It's already profitable, by the way. It's not like, it's a growth play. Or obviously, it's a growth play, but it's more to it than that. It's already profitable. It's a good company, and it's hitting record EPS, revenue, basically everything. So really positive from my perspective. Genius. I read a really good article actually on Seeking Alpha. Basically, from their point of view, it trades at a discount on a price to sales ratio, currently 2.5. Futures in this current year is under 2. Depending on how you want to pitch it, it should be somewhere between sort of 4 and 6. If you look at DraftKings, maybe 5 is the kind of long-term enterprise SaaS model. It also argued as well, it's like a mini Bloomberg in the way that it kind of sits between like aggregating data for companies to use, which I thought was interesting. And overall, I just think the article was really well judged, well balanced. Like, it basically, from their point of view, he doesn't have the right risk profile to buy it, but he understands people that do ultimately. And from his perspective, it does look cheap, but there are lots of risks involved, basically realizing all this potential. So I thought it was a good article. Next up, we got Phoenix Group here. Some good news on Phoenix. So they went ex-dividend, and it's an 8% yielding company that pays 2 dividends a year. But fairly unusually for a UK company, their final and interim dividends, as they're called, are exactly the same. So next time should be 24.8 plus. So actually, the share price, although it went down 1.74%, 4% of that, as in, minus 4%, was because it went ex-dividend. So actually, it kind of had an okay week, I would say. Also, as well, this company continues to attract buy prices. JPM and Royal Bank of Canada both came out with updated buy figures. RBC was already a buy and reaffirmed its number. JPM went from neutral to overweight. Both of these are way above the share price, which is currently like around the 630, something like that. And to me, like when I get the dividend here, which will be my largest dividend, about £300 dividend I'm expecting, I'm just going to put it straight back into Phoenix. I think it's a really good long-term dividend play, pretty safe in a volatile market. So I'm sort of missing those companies at the moment. Next up, we have FEVR. There was also another good article on Seeking Alpha. It kind of highlighted a lot of the things that I highlighted in a video I did on them a few weeks ago. Basically, lots of potential, good product. Everyone loves it, but valuation is not so cheap. And in order to justify the current multiple, it has to really kind of up its game, sort its logistics issues out, etc. So for me, it remains a hold. Actually, this company, as in Seeking Alpha, sorry, also kept it as a hold. Lots of potential, but it does look expensive. Yeah, for me, I plan on holding my current stake more or less, as we'll touch on in a second with my buys and sells. And really only selling above sort of once it gets to crazy levels, and likewise buying more if it gets sufficiently cheaper. But right now, I think it's a hold myself of where it currently is. Next up, we have T-Row. I think I have a really good average price here, as I touched on beforehand. It does actually attract at the moment a lot of analyst downgrades. I would caveat that the downgrades are still significantly up on what the share price is, with the exception of Citigroup, which has a 136 share price target. All the others remain sort of neutral or even sell, but actually are higher than the 152 current share price, so it's slightly odd there. For me, I really like it under 150, so I won't be selling this on the same hand unless it starts with a 200. So for me, it's kind of a long-term hold realistically, unless I get a really great price for it. And last but not least, Salesforce, not a huge movement on the week. TipRanks had an article that I would class as broadly positive. It highlighted an aggregate buy price of $303, so plus 38%. For me, I like Salesforce. I don't directly work with it, but I sort of work with people that do. My wife is actually heavily involved in like Salesforce migrations, that kind of stuff. And I do enjoy Tableau. It's like visualization tool as well. I think it's basically building a very nifty suite of products. And as long as it can keep up its growth rate, it's obviously a steal at the moment. The question is can it continue growing, or is it going to have further chunky acquisitions to digest that may push that further down the road? Who knows? But actually, broadly speaking, I was happy with how my top 10 performed this week. I'm kind of surprised that both GAMA and National Express weren't more positive, because I think GAMA at the moment looks cheap. And National Express might have benefited more if there was more on the peace talks, because at the moment it's seen as being overly exposed to oil. I think that's not correct because of the way it hedges, but there you go. And Amcor to me is a bit of a weird one, just because I don't really understand why it went down 10%. So that's fine. But anyway, I'm broadly happy with the top 10. I think they held up reasonably well considering everything, and more or less were neutral on balance. So anyway, without further ado, let's have a look at the buys and sells. There aren't a ton this week though. All right, so in terms of my buys, the main call out here is going to be S4 Capital. I would describe this as taking a calculated gamble. I already had about 0.8% of my portfolio in it. So with this addition, I'm at about 1.4%, maybe 1.5, something like that. Really, it had a huge fall. Basically, the results were delayed for the second time in a month because of time taken to sign up by the auditor. This is a company that's very new but has been growing very rapidly. It's headed by Sir Martin Sorrell, who's he's a bit of a legend in the advertising world. And I suspect that the sign off is quite complicated, but it seems to be taking a lot longer. But basically, reading between the lines, I don't think there's a problem here other than bureaucracy and complexity, and maybe S4 and or PwC, their auditors, just taking longer than expected. I read like reassuring updates from both companies. I don't think there's anything untoward here. Also, as well, looking at Sorrell, like this is his swan song. He sort of was forced out of the company that he founded. And I just don't believe that he would risk his legacy on fraud or anything untoward of that. Like the man's a multi-millionaire, and it's just not worth his time to do so. So I think here, like, this is a calculated risk, but I think I'm okay with it. Also, as well, I'd point out that I used some of my bonus that I got to finance this. So it sort of felt like free money. I know it's not. Maybe that's not the best way to look at it, but it was like, this is money I wasn't really planning on getting. It was a bit of a bonus for me, especially because it's a relatively new job. So actually I was really delighted with the money that I got from my current employer. And yeah, so I put a bit of it into S4 as that. I was like, well, okay, let's just gamble with it, right? So for me, it felt like a good time to average down. Now I am quite red on this still, down about a third, which is about £500. But again, I feel okay with it. And to me, it was also mentally, I prepared myself for quite a volatile ride with this stock. Like, it does trade on a huge multiple. It is trading on Sorrell's name somewhat, but I also think that their premise is correct. That basically you need to be smarter on data-driven return on investment from advertising spend, and they've bought a lot of companies and have a lot of tech that basically enables you to do that. So again, calculated risk, that's my rationale, and we'll see whether it works out or not. And I did just want to highlight GAMA as well. I touched on this last week. Also, 2 of my subscribers got in touch with me to ask me about it. Interestingly, both of them are in the industry, so that was kind of funny, as in telco industry where I work, and obviously GAMA is a telco as well. I did mention that there was a video on the way. My wife's been involved in a very large project for the last 2 weeks, so I've just been not having the time because I've been having to cover more at home, but wifey's aware of that, so hopefully I've got some time to finish this up. I have drafted the video. It is ready to go. For me, anything under 1600 is a buy. You can see I'm picking these up at 1386, so it's a very easy buy for me at the moment. And there'll be more on this in the next day or two. Just need to find time to record it, so bear with me just for that. But that's all my buys this week. I don't really think it's worthwhile spending time on the rest. They were primarily from either dividends or leftover, or the stock that I sold to buy Elixir, which you'll see in just a second. Let's have a look at that now. All right, so FEVR, we touched on it already. I think it's a hold, broadly speaking. I'm actually trimming my position from 255 to 225 is the plan in the long term. So far, I've sold 4 shares over the last 2 weeks. It's basically hovering around my buy price average. So when it's green, I have a look at 9 o'clock each morning before I start work. If it's green, I sell a share and then use that share to buy Elixir, which is like a very small but very promising company with a huge buy-sell spread. So I'm just averaging into it really gently. And I'm basically just selling down some shares in FEVR. I won't be buying FEVR again until it hits 1550, which probably won't happen considering it's the 1850 odd average. Or unless it gets to like 2400, then I'll consider that a price that's too good to sell. I might even start trimming a little bit more aggressively from about 2200. But again, I still would like to keep a stake in FEVR just because I really like the product, and it does have a lot of potential, but it's not without risks. Basically, it's still a fairly small company. And we'll see how it goes. So again, I did a video on this a couple of weeks ago explaining my thought process. For me, it's very clearly a hold at the moment rather than anything else, mainly. But you'll see here, again, I'm just selling down a share once a day at the most, just to average out of FEVR a little bit and into Elixir again just a little bit. So that's the plan here. So honestly, just that one sell. Like I said, I did most of the interesting stuff last week. And actually next week's update will be a new financial tax year. So that will be exciting because we're going to be in buying mode and adding some more material levels of capital again. So the plan will basically be to add £160 a day to the 2 ISAs, and by doing that, we'll basically fill up both ISA allowances over a 50-week period, right? £80 a day. That's how it translates basically. So that will be the plan. So there'll be a lot more buys starting from next week without the need to sell. But again, I probably will be looking to make small changes to the sells as well, but we'll see. Anyway, that's everything I've got from this week. Hopefully everyone else has been having a fun week and a few months as well. I know it's been quite challenging. Been good fun for me. Pretty brutal on my Russian holdings, which I've stopped talking about, but only because they haven't been changed, and actually I can't buy into either of them. And Evraz itself is entirely not possible for me to buy shares at the moment, even if I wanted to. And Polymetal is in a sell-only state as well, so I just have nothing to add rather than anything else. So. But this is my current portfolio as it stands. There will also be a monthly update in the next day or two, just because obviously it's a new month, so we're going to have a look at March and how that did. For now, though, hopefully this will keep everyone happy. I've been the Boss Hog. Thank you very much for watching, everyone, and good luck with your investing. Bye for now.